Hello viewers, welcome to my YouTube channel, OneRajKamal. The week ending June 24th was a pretty good one for the markets. During this week, all the indices went up. S&P 500 went up by 6.4%, Nasdaq by 7.5%, and Dow Jones by 5.4%, as you can see on this chart. Even the crypto markets did well. Bitcoin is up 13% over the last 7 days at the time of recording this video. ETH is up higher at about 24%. And all of this in the markets has been accompanied by strong volumes. So volumes have seen an uptick. So overall, a good bounce in the week. I still call it a technical bounce. A technical bounce happens when sentiment is very low, when there are oversold conditions. And we had talked about exactly these things, including one of the lowest indicators on University of Michigan Consumer Sentiment Index. And we'd also talked about support in S&P 500 at about 3,600. See this chart of American Association of Individual Investors. AAI comes up with investor sentiment charts every week. And you can see on this chart that the bullish sentiment is at 18% and bearish sentiment is at 59%. This is one of the lowest ratings that I've ever seen. Typically, bullish numbers are about 38%. That's the historical average. And bearish sentiment is at about 30%. This is another evidence of market being extremely bearish, sentiment being really down. And these are absolutely ripe conditions for the kind of bounce that we have seen. So that's the reason to call it a technical bounce. There's another thing which has happened in the market, which is that the 10-year yield has come down. The 10-year yield has come down, as you can see on this chart, from about 3.48% on 14th June to about 3.138% at the close of trading action on Friday, June 24th. That's almost a decline of 34 basis points in 2 weeks. So this is really giving the market a sigh of relief. High interest rates, high 10-year interest rates make the markets go down. When the interest rates have come down and come down pretty quickly, the markets seem to be rallying a bit on improvement in sentiment. But is this really bullish? And that's the question to ask ourselves. I want to show you two pictures, the picture of copper and the picture of oil. Look at this picture of June 2022 copper futures. The June 2022 copper futures have come down dramatically. They've actually collapsed from about 4.4 to a dollar to about 3.7 per dollar. And this is again in roughly 2 weeks' time. Look at this another chart. This is the price of crude. And you can see the price of WTIC rolling over. It's come down from about $124 per barrel to about $108 per barrel. It would have been much lower were it not for the big jump in the price from about $103 to $108 on market action that happened on Friday. So decline in the price of copper, decline in the price of crude, coming down off the 10-year treasury yield, all happening quite dramatic, big numbers in the last 2 weeks. Markets rallying on that is a question for all of us, because to me, it seems the other way around. To me, it seems that if copper, or Dr. Copper as it is called, and oil, if they are going down, they signal tougher economic conditions ahead, a weakening global economic environment. That's why copper and oil are going down. And the 10-year yield coming down by about 34 basis points in 2 weeks seems to reflect that. So therefore, the bounce that we're seeing may not be long-lasting, may actually be a temporary reprieve, because the fundamentals of the market seem to be deteriorating. Now, we have to remember that as some of this is happening, the Fed is actually tightening. The Fed has increased its Fed funds rate by about 75 basis points in the last meeting, and is expected to continue on a tightening path in the coming Fed meetings as well. Every time in the past, whenever the Fed has gone on a tightening cycle, it has led to something breaking down and the markets collapsing. Whether it was the banks crisis of the 1960s, as you can see on this chart, or whether it was the LATAM debt crisis of the 1980s, or whether it was the LTCM crisis of the mid-90s, whether it was a tech bubble crisis of the early 2000s, whether it was the subprime crisis of 2008, or whether it was the repo rate crisis of 2019 September. Every time the Fed has gone on a hiking cycle, it has broken something, and then the Fed has had to cut down the rates because the markets collapsed, and there was an overall economic downturn and a recession that happened. Now, in the current cycle, the Fed is actually doing more, and it is important to note that the Fed Chair Jay Powell last week said that the Fed plans to reduce its balance sheet by 2.5 to 3 trillion dollars. The Fed balance sheet is currently about 8.9 trillion dollars, and a reduction of 2.5 to 3 trillion dollars on that is really massive. Now, let's see how the Fed's balance sheet has grown. So the Fed's balance sheet was about $1 trillion in 2008, before the great financial crisis. When the 2008 crisis happened, the Fed embarked on a process of quantitative easing. And over 3 rounds of QEs, the Fed's balance sheet grew from about $1 trillion to over $4 trillion over the next 4 to 5 years. So a 4x increase. The Fed then started talking about reducing the size of the balance sheet. It talked for a bit, started actually reducing the balance sheet only in 2017, 2018, and went about in that journey, but it was able to reduce its balance sheet by only about a few $100 billion, actually less than $1 trillion. The Fed's balance sheet never came below $3 trillion. What happened then is that the COVID crisis happened, and the economy was forcibly shut down. In response to that, on 15th March 2020, the Fed actually announced another round of quantitative easing. It had actually talked about buying $500 billion of treasury securities and $200 billion of government guaranteed mortgage-backed securities, but it did more. And just in the month of March, the Fed's balance sheet saw a massive stimulus. It grew from under $4 trillion to nearly $7 trillion in a matter of like 2 to 3 weeks. That was the extent of stimulus provided, and we would argue for the right cause and for the right reasons, because the economy had been locked down. The global economy had been locked down due to the COVID pandemic. In June 2020, the Fed came out with another plan, and it said that it would reduce its rate of purchases to about $80 billion of treasury securities per month and $40 billion in mortgage-backed securities per month. So reduce the pace of buying, and this was announced in June 2020. The Fed continued on this policy till November 2021 for almost 18 months. During this period, the economy began to recover, vaccines came, everything opened up, markets reached all-time highs. You would argue frothy highs. Price to earnings multiple reached, absolutely crazy levels. Housing and commodity prices boomed, and yet the Fed continued on the same policy of buying treasury securities and mortgage-backed securities at the same rate at which it was doing in June 2020. Only in November 2021, the Fed came out with a plan to reduce the rate of purchases, not stopping purchasing, but reduce the rate of purchases of treasury securities and mortgage-backed securities. The overall purchases continued till March 2021. So even though the rate of purchase was declining, because the rate did not become zero, the purchase of treasury securities and mortgage-backed securities continued till March 2022. In fact, Fed's data shows that between September 2021 and March 2022, the Fed's balance sheet grew by $500 billion. This is 50% of the Fed's total balance sheet before the 2008 crisis. That was the extent of buying in the last 6 months of the Fed's continued QE program, when there was absolutely no reason to do it. And buying even mortgage-backed securities when the housing market was really, really frothy. Now from this, now we're talking about tightening, and we're talking about shrinking the balance sheet, and we're talking about doing this to the extent of $2.5 to $3 trillion. And we're talking about doing this along with the 75 basis points to potentially 100 basis points increase in Fed funds rate. You can imagine what that could do to the market. This is something that I don't think is likely to happen. However, the path on which the Fed is going seems to me to be headed towards a recession. And I don't think any bounces that are happening in the market currently are fundamental long-term bottoms. These are technical bounces. Thank you for joining me today. You can follow me on my Twitter handle at OneRajKamal and Instagram at OneRajKamal. Thank you.